Hey guys, Jared Wesley here of Live Traders and back for our regular weekly lecture. This week's topic is trade management secrets, the power of the 84% rule, guys. I've been getting a lot of questions about what is the 84% rule, how does it work, why does it work, etc. and so forth. And as you guys know, there's a lot of different ways that you can manage trades, right? There's no one size fits all for trading. And for me, that was one of the hurdles that I had to overcome when I was a new trader, because I was taught, well, if you manage on pivots, that's a really profitable way. It's the best way to trade. But it wasn't for me. I didn't have the patience to manage on 5 and 15-minute pivots. So I struggled for the first 3 to 6 months figuring that out. Well, the good news about today's topic, guys, trade management secrets, is that the 84% rule, in my opinion, can and should apply to almost all traders out there. Now, if you're a really terrible trader, the 84% rule might not be so good for you, because bad trades are still bad trades, right? It doesn't matter how well you manage a bad trade, it's just a bad trade. But if you've gotten yourself to a reasonable point where you're a break-even trader, slight loser, slight winner, the 84% rule, guys, can be extremely powerful. And what this rule basically is saying, hey, look, if you stop out on a trade, you take a full loss. Let's say, for example, you wanted to get into a stock at $50 as your entry, your stop loss is $49, and your target is $52, okay? So entry 50, target 52, stop loss 49. So that means if the stock goes against you, you will get out at $49 and take your loss. So if you bought 100 shares of that and the stock stopped out at 49, you'd lose $100. If the stock went to 52, you'd make 200. But as you'll see here in the video, what if the trade doesn't work? Can you still make money off that stock? That's the question. And one of the most frustrating things that we see in trading, and again, you'll see it in the slideshow here, is when we get stopped out of a trade and watch it go down to $49, stop us out, lose money, and then what happens sometimes? They go higher for the entire rest of the day. You sit there and you want to just, frustration, right? Just, because you were right about the stock, but your timing with the entry was wrong, okay? And this happens very frequently to traders. You might get tagged by a couple pennies, you might get tagged by $1, whether it's the market falling against you or some news report that randomly came out, or sometimes trades just don't work. But it's so annoying and so frustrating to watch a trade that you were in previously and lost on end the day much, much higher. Well, this is where the 84% rule comes into play. You are going to get back into all of those trades that gave you full stop outs, and they're going to work 84% of the time. From my personal experience, having done this, having back tested over 1,000 trades on it, I believe it might not be exactly 84% for you, but it should be somewhere above 75 to 80% that the second entry works using the original entry. So guys, please take a look at this lecture. It's really good. It's a little bit different than some of the other ones, because this can really genuinely supercharge your trading, all right? Just remember, this is for my trades. Your trades, the percentage might be a little bit different. And stick around to the end of it, because the last 3 or 4 slides are the money slides, where it can show you just how big of a difference this will make in your P&L. Guys, I am telling you, 50 to 100% more money at the end of the year. And you guys know me. I'm not one of those fluff artists like, ooh, check this out, and it's just a bunch of garbage fluff. This is a real thing that I use frequently, and used it yesterday on Apple. I stopped out on the first trade, lost $500, and I worked on the second trade, and I made $1,000 on the second. I netted $500 out of what normally would have been a $500 loss. So stick around, guys. Watch the presentation. It's about 40 minutes, give or take. And don't forget, you can get a $1 30-day trial into the Live Traders chat room by checking the link in the description. $1 30-day trial, check the link in the description. And as always, guys, if you like these videos, well then click that like button, and also, just hammer that subscribe button as well. There's a lot of great content on the Live Traders YouTube channel. I'm Jared Wesley, guys. Let's get to it. Today's lecture topic is called Trade Management Secrets, the power of the 84% rule. I've been getting a ton. My email box has been crazy. Even on YouTube and elsewhere, I've been getting a lot of questions about what is the 84% rule. So to be clear, guys, I have talked about this topic in the past, and some are going, oh, I've already heard about this. I've done something a little bit different today to make this a little bit more interesting for the folks that have been through this. I talked about the 84% rule about a year ago. I think it was actually January or February of last year. It's pretty much all new slides. There might be 2 slides that are the same. Everything else is fresh. But towards the end of it, in the back half of this, I talk a lot about what it really looks like and how it can really change your trading year. And I think a lot of you are just not understanding just how powerful this really is. Okay, I'm going to repeat that because you're going to see later on, you're going to be like, wow, holy you know what. It's to not give away the end, you're looking at a possibility of an extra 50 to 100% per year on the bottom line. Okay, so if you're used to making 50 grand a year, think about making 75 or 100 grand a year just by this one little secret. Okay, I'm not kidding when I say this. I'm absolutely not kidding. Okay, so let's dig in, guys. Trade management secrets, the power of the 84% rule. So before I get into actually specifically talking about the 84% rule, see, everybody's familiar with the 3-bar play. It's like the hottest trade or idea going out there these days, and I'm not going to spend a lot of time on it. You guys have seen these slides before. These are in other videos. These are in other lectures I've done. This is a really nice 3-bar play. The first bar might be a little bit too big, perhaps. If it was at like 67 or 66, it would have been a little better, but you understand the basic comment. Wide bar, narrow bar, rip. That's a standard 3-bar play. Okay. Now the 84% rule, which I haven't discussed yet, is valid on all patterns. It doesn't have to be a certain pattern. It could be breakouts, breakdowns, buy setups, climactics, 3-bar plays, whatever. Okay, but this is what it looks like when you take a good trade, right? That's what a good trade looks like with a good result, right? You buy here, stop here, target up here, and it's boom, right? Beautiful. Let's do it again. We're going to do a few more of these. This is what it looks like on the downside. Wide range bar breaks below support, followed by a narrow range resting bar, and the result is this, right? So wide bar, narrow bar, drop, and you get your target relatively quickly, okay? Relatively quickly. That's a perfect pattern, and they're awesome when they happen. They do happen. 3-bar plays happen every single day. I'm not even going to get into all that stuff, but they happen every single day, okay? And sometimes they work as beautifully as this. And then we get these types of trades. Here's another 3-bar play. Wide bar, narrow bar, rip. You even get a buy setup. I mean, this chart's amazing, okay? So we're looking at these and we're going, wow, we get it, Jared. We know what a good 3-bar play looks like, right? We know what a good buy setup looks like. We're past that point, okay? How do we make more money now, okay? Now, I want to be clear here, and I'm going to reiterate this. If you stink as a trader and you're just bad and you just take really bad trades, there's not much that's going to be able to help you except becoming a better trader, which means learning the technical charts better. Okay, so if you're brand new and you really have no idea what you're doing, you have to learn the basics first. The basics are, what is a 3-bar play? What is support? What is resistance? What is basic money management, trade management, etc.? Like, this is a great buy setup. But if you're a brand new trader, you don't know that this is a great buy setup. I know it's a great buy setup because it's got a bottoming tail, a narrow body, narrow range doji bar. It's a 50% retracement at a rising moving average right at minor price support or level 2 price support. Wow, there's a lot of goodness here. Okay? Push that aside. These are what really good trades look like, right? And this is what good results look like, right? Wide bar, 2 narrow bars, and it drops. There's no heart palpitations here. There's no twiddling your, biting your fingernails or, oh my gosh, is it going to work? There's none of that stuff. This is what we all hope for, right? Every trade we take, we hope this happens. You get into a really nice pattern, and it's a smooth move right to your target. But, newsflash, they don't all happen like that. right? Not all trades work the way the last 4 trades I showed you are, even with great patterns. Yes, people, yes, there are truly outstanding patterns, really good patterns that fail. Okay, so the last 4 slides we saw, 5 slides, whatever, were really nice. And they worked exactly the way we hope all trades will work. But if all trades worked that way, we would all have 100% batting average, wouldn't we? There wouldn't be a need for stop losses, and this is wonderful. We'd all sing kumbaya. But that's just not how the reality of the situation is. Okay, this happens. Okay, really nice wide bar, narrow bar, drops and then stops you out. Okay, I lost $592 on Baidu, and to be honest with you, there's really nothing wrong with this thing. Okay, gap down, it's not an excessive gap. It's got a beautiful first wide range bar followed by a narrow range second bar. It triggers under the whole number of 135, 135.10. It actually had a pretty solid move. It went 60 or 70 cents, and then it just went the other way. Okay, that's why we have stop losses. So now we've seen both sides, and I'm just going to show you this real quick. It's the same trade, guys. I just wanted to blow it up for you. You can see the wide bar, the narrow bar, the drop. Everyone complains, your charts are too small. I can't see your charts. It's the same trade you just saw. Wide bar, narrow bar. It drops, it fills us, right? And then it just went the other way and stopped out, okay? So we can see here what really good trades look like, and we can see from a couple slides ago, I'll show it right now, what really good results look like also, right? That's what a good result looks like, and this is what a good trade with a bad result looks like. We've all been there. So one, I'm preaching you have to have stop losses. If you don't, you're an idiot. End of discussion. Hard stops, not mental stops. I've done a lecture on this topic too. So we've seen good patterns fail. So the question then becomes, if they don't work, they just don't work. Okay, that's an angle, right? Get over it. My point in saying to you guys on this is, there are some trades that will never work. We're just wrong. I'm going to repeat it because you're not paying attention. There are some trades that just don't work. They look great, we think they're great, and they just don't work. We're wrong. Admit you're wrong and move on. It means get over it. Get over it. But there's but to this, okay? So if you have a trade that you take and it just stops you out and keeps on dropping, right? Say you go long on a trade, it stops you out and just drops and drops and drops, and so what? Nothing you can do about it. But what if, okay, what if this happens? Ever stop out of a trade by a couple pennies or more, only to watch it go higher for the rest of the stinking day, ultimately hitting your original target? You ever had that happen to you? You stop out of a trade, could be a nickel, could be a penny, could be a dime, could be a lot more than that. I don't know. And then an hour later or 20 minutes later, or whenever later you're looking at it and you're going, you mother effing blah, 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 and you look something like this guy right here. Maybe you are disciplined enough to not put your hand through your laptop or your monitor, but you're still uttering a lot of 4-letter words, okay? I think many of us would agree it happens more often than we like, and it's crazy frustrating. There's nothing more frustrating than to either have an HFT shake us out or a little silly news report pull the market back for 1 bar and then it goes higher the rest of the day, or maybe you just get tagged by 3 cents and then it turns around and goes higher. There's a myriad of reasons that you might get stopped out on something, some of which can be explained, many of which cannot be explained, okay? And it's annoying as you know what, frustrating as blah, and I'm sure many of you look like this, okay? So now let's take a look at what that looks like, okay? Let's take a look at what frustration looks like. All right, on the left, this is a trade I took on January 6th of this year, a month ago. Wide range igniting bar, followed by a narrow range resting bar, okay, within the upper 50%. So wide range bar, narrow range bar in the upper 50%, relatively equal highs. It's the first or second bar of a move. We get in at 938. I got in at 938. The stop loss is 917. Pop. And when I mean pop, I mean stop. Okay? What happened? The thing stopped me out. And I think we would all agree there's nothing really inherently wrong with this 3-bar play. Really, when you could break this thing down, look at it frontwards, backwards, and sideways, and it's the definition of a textbook 3-bar play. It just is. And my entry was a textbook entry with a textbook stop loss. Okay? And then, wait for it, and then this. And then this. So I got stopped out on this beautiful little red bar bottoming tail. And all this thing did was go higher for the rest of the day. All the way up to like $10.75. How effing annoying is that? Right? We can see it was a decent gap. We had room to about $10 on it. You're in at $9.38. Okay? Exactly. Enough to make a Baptist preacher curse. Okay? So you're in at 938. Stops 970, 21 cent stop. So, I mean, realistically, on something like this, you're looking for like a 42, 43 cent target, which would make it right around 975-ish, give or take. This is crazy frustrating. Annoyingly frustrating. Because you had the right idea at the wrong time. Okay? Let's do it again. Gets better. Okay? So now, here's another stock. Wide range bar. Narrow range second bar, although this is not technically in the bottom 50%, right? That topping tail kind of peekaboos up a little higher, but we have a wide range red bar engulfing a green bar. Stock looks lower in that $50 area, give or take 50.10. It triggers. So I shorted it 50.10. Stop is 50.35. It triggers us, goes down to like 49.80 or something. I don't know the exact area. Pops, stops us out. And then the target is hit later in the day at 2 o'clock, right? And this one stopped out by a lot. This didn't stop out by a couple pennies. It stopped out by a lot, but the target on this was somewhere around 40.60. This thing ended the day at like 40.30. So again, right stock, wrong timing on the entry. I'll repeat, right stock, wrong timing on the entry. It's frustrating, isn't it, when you look back later and you're like, you son of a gun. Okay? We're going to do a few more of these. Okay? Here is a sell setup on Tesla. You guys are going, $500 in Tesla. What was that, like 4 years ago? No, it was more like 24 hours ago. I'm joking. But anyway, right? So Tesla drops, leaves a bottoming tail and bounces. Leaves a topping tail, and there's a sell setup right here, right? Higher low, topping tail, narrow range doji bar, narrow body doji bar, I should say, and about a 50% retracement. Take the top here and the bottom, it's about 50%. This is a good sell setup on the short side. So you get in at 528.75, give or take. The stop loss is around 531, give or take. It triggers you in right here. You can see the green bar, and then right over here, look to the right, right over here, it stops you out. Okay, we stopped out. But then later in the day, it ultimately goes to your target. Your target was somewhere in the 523 range, 524 range, whatever. The stock goes to like 516, 517. It's crazy frustrating, isn't it? Because you know you're right with regard to the idea of the direction of the stock, but your timing was wrong. Let's do it again. All right? All these were within the last month, by the way. Every one of them. All right, this was last week on NVIDIA. All right, we have a kind of a pseudo, it says a pseudo 3-bar play. Why? Well, we have a green bar here. This was a wide range red bar, but it left a bottoming tail, which is extremely bullish. And we're looking around the 244, 243.90 area. Again, it should have a relatively equal high. You could argue it doesn't. But your entry would be 243.90. Your stop's 243.40. What happens? Triggers us in right around the 244 area, and then look to the right, it tanks. Goes down to 241, breaks the low of the day, and then what does it do for the entire rest of the day till the market closes? It grinds higher. Got up to like 249. Okay? So again, the right idea with regard to the right stock and the right direction, but the timing of the entry didn't work. Okay? One more, I promise. One more, I promise. This happened recently, last week, give or take. Buy setup on Apple. Lower high, lower high, lower high. Green bar triggers entry. So entry 313.40, stop loss 312.60. It's a buy setup. 50% retracement from the top to the bottom. Looks good. Relative strength to the market. What happens? We get stopped out over here on Apple, and Apple goes higher for the rest of the day. Every one of these examples I just showed you happened in the last month. Every one of them. And guess what? Every one of these examples I traded. I'm not just taking examples for the sake of taking them. I took every one of those trades and I stopped out on every one of those trades. 1, 2, 3, 4, 5, 6 of them. Okay? Some were better than others. Some were just straight textbook. Like, it's really hard to argue that SDC was not a perfect pattern. Okay? It's really hard to argue that. Okay? But perfect patterns fail. Some of these were mediocre patterns. But at the end of the day, this is how you feel. You sit there and an hour later you're like, you son of a... I knew I was right on that. But you're only right, really right, unless you make money. Am I wrong? You're only really right unless you make money. Okay? Thank you, Grant. It's the title of the presentation. Okay? You're only really right unless you make money. So you have two choices. Okay? Two choices. Accept it and just buy more monitors. Right? That's it. You can just accept it that you're going to be wrong sometimes and you can just buy more monitors because the frustration is palpable and you're going to throw some across the floor and just have a closet full of mice, whatever you want to call them, new monitors, keyboards, and whatever. So that when this happens to you, because this was 6 times last month, that you can just throw it against the wall. All right? That's one thing you could do. That's one thing you could do. Or you could try something a little different. Okay? Or you could try something a little bit different. You could use the 84% rule. All right? What is this rule that I'm talking about? The 84% rule is simple. It says this. If I take a full stop out, not a trailing stop, to be very clear, not a half stop, not a trailing stop, a full stop, meaning my original stop loss was triggered. If I take a full stop on a trade and get back into that same trade, if it retriggers, because they don't all retrigger, if it retriggers my original entry using the original stop loss. So basically, I'm getting back into the trade at my original entry point with my original stop loss. The second trade works 84% of the time. The second trade, the second entry works 84%. Now, I want to be clear about something. There does not have to be a pattern for the second entry. The second entry does not have to have a pattern. Okay? The first entry should always have a pattern, right? The first entry better be a damn good idea. Otherwise, why are you taking it? Okay? Why are you taking it? But the second entry simply needs to re-trigger the original entry with the original. It's that simple. Use the exact same management that you used on the first trade. Okay? It's that simple. Okay? Now, let's take a look. You just saw a whole bunch of these. I'm going to show them up again. Same trade you just saw on SDC, that perfect 3-bar play that stopped out. Well, there it is, stopping me out right there. Okay, right there. Get back in at $9.38. Note, there is no re-entry pattern right here. There is no re-entry pattern. You just get back in at $9.38 because that's where we got in the first time. The original stop loss was $9.17. So use the original stop loss at $9.17. Guess what? There's your 2-to-1 target at $9.80. There's your 2-to-1 target at $9.80. Wow. 22 or 21 cent stop, 42 cent target, 98. And even then it went up much higher. So the first trade, as an example, you lost 500 bucks on the first trade, you make $1,000 on the second trade, you net 500 versus losing 500. It's a 2-to-1 swing in your account. So if you didn't get back in, you lost 500 bucks that day. If you got back in, it's an 84% chance it works, and you'll make 500 bucks. Let's do it again. I have a whole bunch of these, so bear with me, all right? But towards the end, I break this down in great detail for you, and that's the hook, so to speak, okay? So stick around, because in about 4 more slides, you're going to see what I'm talking about and just how big of a deal this is. Just how big of a deal this is. Here's that other trade. Again, I put them all in order. I stopped out on the first one. See the pink line? I stopped out. It dropped, it bounced, and it took a while. But this thing re-triggered at about 10:45, 10:44, something like that. Okay? Right there. Now note, I would never in a million years take this entry. 1, 2, 3, 4, 5 red bars in a row, and I'm shorting the bottom of 5 red. I would never do that. But the 84% rule is powerful. I don't have a choice now. I'm re-entering the original entry. Okay? So we got in over here at like 9:34 in the morning. We're getting back in at 10:44 in the morning. Same entry, same stop loss. Guess what? There's target. There's target. You would have lost 500 if you took the first trade and you were finished. If you took both trades, you make 500. Now, again, you can double this if you're at $1,000 risk, whatever. It's crazy awesome, isn't it? Now you don't have to break monitors and keyboards anymore. Just get back in. Now, remember, to be clear, not every trade will give you a re-entry. I want to be extremely clear. Not every trade will give you a re-entry. I will talk about that in a minute, how frequently re-entries happen. I'll talk about it in a minute. So here's that sell setup on Tesla. All right, here's the sell setup on Tesla. 528.75, stop loss is 531. We stopped out. How about getting back in? There it is over here. It re-triggers around 2 p.m. 528.75. Triggers, chops around, bounces, doesn't look so great, but holds the stop loss. There's target. Instead of losing $500 after the first trade and going home with your tail between your legs, you take the second trade, you make $1,000, you net 500 bucks that day. 84% chance the second trade works. Couple more, guys. Here's the other trade we talked about. Isn't this really strange? All of these trades all happened in January, and I took every one of them. Okay? I'll get to that in a second as well. First trade stopped out. You can see it over here. It stopped out down there. What do? Get back in over here. Note, there's no re-entry pattern here. We're just getting back in at the exact same area that we originally got in, using the exact same stop loss that we originally used. And what happens? NVIDIA went higher for the rest of the day and hit target not but what? 5, 10, 15, 25, 30 minutes later. You could have just taken the first trade and lost 500, or you could have taken both and made 500. Next. These are all the same trades I just showed you guys. Okay? Apple stopped me out earlier in the day. You can see the pink line here. Stop me out. Over here, it re-triggers the entry. Okay? It re-triggers the entry using the same stop loss. Target 15 minutes later. Same deal. You could have lost 500 for the day, or you could have made 500 for the day. Your choice. We're going to do it a couple more times. All right? Here's a breakout example. This is from a while ago. This one is not from January. Here's a nice breakout or an ascending triangle, whatever you want to call it, right? Flat top, higher lows. Flat top, higher lows. Technically, it's an ascending triangle. Call it a breakout, whatever. It pops, pulls back, and shakes the tree hard, right? This thing shook the tree hard. It broke the low by a penny or two. And then did what? Ripped higher. Your target's 1940. Well, it went to at least 1943, 44, something. Shook the tree, ripped later. Can we go back to this for a second? How? Oh my gosh, bad does that feel? Let's go back. So this is you right after this red bar. Look at the bottoming tail on the 15-minute here. Look at that. How pissed off are thousands of traders out there that they just got shaken out of what looked to be a really good pattern. It was also moving in the right direction, and then this happens. Get back in. Get back in. Let's do one more. Last one. Aren't these your favorites? These are my favorites. Not. The ones that peekaboo you in, that's what I call them, little peekaboo trades. So what we have here is a breakout, and it peekaboos in by about 2 pennies. So your order's at $80, and it goes to like 80.02. It just sneaks you in, and then does what? Drops the hammer on you. Snuck you in, dropped the hammer. Now remember, we've done volume lessons. A volume spike with little to no price movement equals trouble. You should have known this was trouble, but things happen quickly. So it peekabooed over, huge volume spike, and didn't have any follow through. Stops you out. Guess what? Get back in over here at 80 bucks. Get back in over here at 80 bucks. Put your stop at the exact same area it was, and there's your target. It was only a 15-cent stop. You needed 80.30 for your target. So you went to like 80.60 or 80.50. Okay? Isn't that annoying when you get peekabooed in? Isn't it annoying when you get shaken out of a trade only to watch it go higher? This is real stuff. It is infuriating to watch that happen. Okay? So now's the good part. I want you guys to take a look at how this really breaks down. Okay? Now remember, you could just accept it. You have a choice here. You could just accept it and buy more monitors. That's your choice. Or you can think about how to take advantage of it and use an 84% rule. Now, many of you are wondering, well, sounds great, Jared, but let's take a look. So this is what I would consider an average month. I typically take about 50 trades a month. In full disclosure, I took 40 trades in January. I didn't even take 50 in January. Okay? This is no re-entry trading on the left. This is trading with a re-entry. Okay? So, 50% batting average, which is pretty close to where I usually am at. Okay? 25 winners and 25 losers. Okay? Makes sense. There's 50 trades, 25 win, 25 lose. If your win-loss ratio, remember we talked about win-loss ratio a couple weeks ago. I did a whole video on batting average and win-loss ratio. Go check it out. So if your win-loss ratio is 1.8, which is reasonable, it's never going to be fully 2.0. That means 25 times 1.8 is 45. You'll make 45 R on your winners. Okay, you'll make 45 to 1 on your winners. All right? 25 losers, you're going to lose 28 R. Why? I included slippage and fees. That's realistic. You're going to lose an extra 2, 3, 4 R every month in slippage and fees. Okay? So the net here is 17 R a month. Now, I'll skip for a second. Overall, 17 R a month is not a bad month. It's not like you're a terrible trader. You're doing all right. You made 204 R on 600 trades. That's a 0.34 expectancy. That's pretty good. If you are an intraday trader, 0.2 to 0.5 is a really good expectancy. People are going, what's expectancy? That's how much money you make on every trade you take. Winning trades, losing trades, every trade. So in this case, you make 0.34 R on every trade you take. So if you were risking $100, you would make $34 for every trade you take. That includes winners, that includes losers. You make $34 every time you push the button if you had a $100 risk. If you had $1,000, it means you make $340 every time you put the button. Overall, that's a solid quality trader. There's nothing wrong with this trader. They would have made $100 grand that year. Nothing wrong with it. You want to supercharge it though? How about you look at the 84%? So now, for me, and I'll show you this in a second, okay? In January, there were 8 re-entries, okay? 8 trades that stopped me out that also gave a re-entry. There were 8 trades that stopped me and also gave a re-entry. 8 out of 20. I had 20 winners and 20 losers, okay? So that's 58 trades if you use the re-entry, because now you're adding those 8 and you're getting back in. So if you had a 50% batting area, except for the 8 re-entries, because you're going to have an 84% on those, that means you have 31.72 winners, all right? 31.72 winners, 26.28 losers with the same win-loss ratio, okay? So that means you make 57R on your winners, and you'll still lose about 28, 29R on your losers. You're now netting 29R versus netting 17R. So 333R versus 204R. 0.48 expectancy versus a 0.34 expectancy. And overall, that's just outstanding. Outstanding. A $66,000 difference in your P&L. All right, 64,000 if I did the math wrong, okay? Something like that. So let's break it down. All right? Overall, guys, all right, you made 63% more money, okay? Yeah, I think I made a typo there, something like that. But nonetheless, you made 63% more money, but it only took 16% more trades to do it. 63% more money, but only 16% more trades to do it. Think about that. That's insane. Now, some of you are saying, well, geez, it'd be nice to even be this kind of a trader on the left. I agree. There's nothing wrong with being this guy on the left. But what if this applies to you, and even if you're only making 5R a month, and now you can make 63% more, which would be 8R a month, give or take. Wouldn't that be an improvement? Of course it would be. Of course it would be. And all you're doing is getting back into trades that gave you full stop outs. You're not thinking about it. Move this up to $1,000 risk. 333 grand. Again, all you are doing is getting back into trades. You don't have to think about it. You don't have to worry if there's another re-entry pattern. You don't have to do anything except set your bracket order and walk away. If it re-triggers, great. If it doesn't, oh well. Some of these trades you will close at the end of the day for a little bit up, a little bit down. This happened 8 times in the month of January to me, which I've already stated. 7 of them worked. 7 of the 8 re-entries worked. So far in February, it's happened 1 time, right? On Apple, it was yesterday, I think. And it worked. So far this year, it's happened 9 times. It's worked 8 of the 9 times, okay? It's worked 8 out of 9 times so far this year. I just showed you like 5 or 6 of the ones from January. I'll show you the Apple in just a second, okay? Now, to be clear, not every re-entry works. Hence 84%. 16% of them fail. Right, so here's a nice little 4-bar play flag wedge. It pops. You stop out over here. You get back in over here, and it just didn't work. That happens too. Just a lot less often. A lot less often. So yes, sometimes you'll take the original entry. You'll stop out. You'll get back in, and the second trade will work too. That will happen. Okay? They don't all work, right? This is a trade that went higher, pulled back. If you had gotten the second entry right here at 84, see it right here? The second trade would have stopped too. This is one that popped, stopped, okay? Technically, I guess it didn't stop. Yeah, it did. It stopped by like 2 pennies right there. Re-entried, second one didn't work, okay? But 84% of the time they do. So far this year, it's 89%. This is Apple from yesterday. We took an early trade on Apple that stopped out. I got back in Apple yesterday. Here it is. Apple stopped, 84% rule possible. I don't know yet. I don't know if Apple's going to re-trigger. Guys, can we be honest for a second? Was the re-entry on Apple a good pattern? No, it was garbage pattern. The re-entry area right here where my cursor is was not a good pattern. Guess what Apple did? It went to like 319. So there it is. Apple 316 by 315, 84% rule play. I called it yesterday. You can see it here. Our target was 318. I think it was 318. Yep, it was. I turned a $500 loser into a $500 winner yesterday. Okay? A $500 loser into a $500 winner yesterday. It's a $1,000 difference in your account. Now, a couple comments. It's important. It's important. From my personal experience, this is the truth. 84% of the re-entries work. I want to repeat from my personal experience. I cannot guarantee you that 84% of your re-entries will work because I don't know if you're a good trader or a crappy trader. You might be the world's worst trader and re-entering your trades might be a minus 84%. I don't know. Okay? I don't know. But for my trades, and I've back tested this on over 1,000 trades, the re-entry works 84% of the time. Over 1,000 trades. So far this year, it's 9 times. It's worked 8 times. All the re-entries were managed on 2RL or nothing. Okay? All of the re-entries were managed on 2RL or nothing. Now, in January for me, I took 40 trades. It was a slow month. 8 of those 40 trades offered a re-entry. So roughly 20% of the trades offer, and I find that to be relatively true. It's between 15 to 25% for my back tests, okay? I think it's somewhere around 18% of overall trades offer a re-entry. So my point I'm making is I gave you numbers based on 50 trades a month. Why? Because I average about 50 trades a month. If you take 100 trades a month, the numbers might be much higher. They might be much better, right? Because you have 100 trades, I have 50. So I stopped out on 20 of these 40 trades. 20. Of the 20 trades I stopped out on, 8 gave me the opportunity to re-enter. 8. 12 did not. They just kept going against me. Again, you get out, you stop, and you get out. My point is 8 offered a chance to re-enter. That's about 40% of your stop outs give you an opportunity to get back in. Okay? The year-end difference from my back test and from doing it personally is roughly 50 to 100%. Some years are better than others, but 50 to 100% increase in your P&L over what you're already making. Again, if you are a consistently losing trader for months and years, I don't know that this is going to help you very much. I really don't know. But if you're a break-even or a profitable trader, I'm fairly certain this will help you. But please, 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 don't do it until you have back-tested this strategy. Don't blindly follow somebody you don't know and have never met just because I said so. It works for me fantastically well. It worked great yesterday on Apple. Worked great in January. But just because I say it's true, it might not be true for your trades. Back-test it on your trades. And lastly, even though it's not last on here, money management supersedes everything. What I mean by this is, if my maximum loss is minus 3 to 1 for the day, if I'm risking $100 and I'm down 300, that's 3 to 1, right? I'm done. I don't care if those losses re-trigger. I will not take them. In my back test of over 1,000 trades, I found it happened 3 times. 3 times. Okay? So to me, it's not a significant issue. All right? But money management is always number one. If you've hit your max loss for the day, wrap it up and call it a day. All right? With your luck, that'll be the 16% day. You'll already be down 3 to 1, and that'll be the 16% day. Okay? So when you take a look at this, it's absolutely, utterly astonishing how often these things work. Now, what does that tell us, guys? What does it tell us? Anybody have any ideas of why this might work so frequently? Now, again, for new traders, it might not work as frequently. But why, for an experienced trader, might this work, or why does it work so frequently? Exactly. Right idea, wrong time. We know what the stocks of interest are. We know what the stocks that have good gaps are. We know what the stocks that have good high institutional interest are. We know all of those things. But sometimes we get the entry a little bit wrong. We just get it a little bit off. So most of the time, we're right with the stocks we're choosing, but wrong with our entry timing. And other times there's just some BS that happens, like a shakeout. That happens too, okay? So it's not that surprising that the re-entry works so well, because we're right with the stock to begin with. We just maybe got a little aggressive, or maybe it just didn't work, or whatever reason, okay? It's fascinating, isn't it? And we did it yesterday. And it worked really, really, really well. I'm not guaranteeing it will work for you this well. I just know for me it works extremely, extremely well. Okay? And as we've said, there's nothing more infuriating, right, than watching yourself get stopped out and then the stock going higher for the entire rest of the day. Okay? There's nothing more infuriating than taking a really, really good pattern, tagging you by 10 or 15 cents, and then watching it do this as you're just squeezing that stress ball. But guess what? You're a loser that day. You're not a winner. You want to tell all your friends that you should have made money on that trade. You should have made money on that stock. Blah, blah, blah. Who cares? Now, I want to be clear. Not all the re-entries are great entries. This re-entry right here where my cursor is, this is not a great re-entry. There's no pattern here, okay? But it works, and it works 84% of the time. So far this year, 89% of the time, okay? And you can see the results are astonishing. Astonishing. 63% more money on 50 trades. Unbelievable. And I can't get over, for me, because in the past there have been times that I haven't taken some re-entries because I thought there's no way the stock's just too extended. It's up 5 bars in a row. It's up 6 bars in a row. It's down 9 bars in a row. And sure as shit, they work. It blows me away even. I'm astonished by it. But just look at the difference in where you could be by doing it, okay? Over 1,000 trades doesn't lie, guys. Now, do it for your trades and find out if you find a similar experience. You might have a better batting average. You might have a lower batting average. But you might find, wow, same thing happens on your trades too. Okay? So, guys, for me, only full stop outs. All right, somebody's asking, what if the first trade goes 1R? I go to break even at 1R, so I don't count that. I go to break even at 1R. That would not be a full stop out. That would be a trail out. I mentioned that earlier when I started. I specifically said this is only for full stop outs, not trail outs. Okay, now you back test it for your style. If you do all or nothing, then back test it that way, right? If you don't do all or nothing, back test it that way. Back test it for your style of trading, which is what I did for my style of trading. Okay, so I hope that you guys learned a little something, okay? 1, they don't all work, okay? 2, 84% of the second re-entries do work. And I hope you guys can appreciate the massive difference between getting back in and not getting back in. I mean, it's pretty astonishing. I'll bring it up one more time. I shake my head. When you put it on paper and look at it on paper, it's amazing. It's astonishing, okay? But please follow these rules, guys. Back test it for your trades first. Minimum 200 trades, 500 is better. From my experience, bad trades are still bad trades. Most of the time when I get a little too aggressive, those aren't the ones that fit in these 8 that re-entered. They're just bad. Bad trades typically are still just bad trades, but we all have those occasionally, okay? So that will do it for this week's lecture. I hope you guys found that valuable. I think it's a way you can truly, and I'm not just, this isn't fluff. I really believe you can supercharge your trading doing that as long as you back test it first. You never blindly follow anybody. That's just dumb. That's gambling. All right, so I hope you guys enjoyed this week's lecture. I will see you guys again next week. To get more great educational content, subscribe to the Live Traders YouTube channel. This way you'll get email alerts every time I upload a new video.